The operating activities include transactions that enter into the determinations of profit and loss. These transactions normally affect income statement accounts. The investing activities include transactions that affect long-term assets and other non-operating assets. And we got financing activities includes transactions that affect equity and non-operating liabilities. In your basic accounting, the operating activities are things that are incurred or activities that are within the ordinary course of business, such as when you pay your salaries, you pay expenses of in selling and admin, you purchase goods for sales, diba? So these are some operating activities. And then investing are activities that when you're going to buy assets that is to be used in the operation of the business. We got the machineries, the office equipments, construction of business, construction of building, or leasing a building. These are investing activities. And the reverse of that, when you pay, that is cash flows. Financing activities includes the resources. Where are the resources coming from? Or the cost, it may come from the owner, or it may come from third party. So how do you finance? How do you make capital cost of your business? Then example of cash flows from operating, we have cash receipts from sale of goods and rendering of service, cash receipts from royalties, fees, commission, and other revenue, cash payments to supplier for goods and services, payments to and in behalf of the employees, cash receipts and cash payments on insurance entity for premiums and claims, annuities and other policy benefits, cash payments, refund of income, taxes, unless they can be specifically identified with financing and investing activities. So, cash receipts and payments from contracts held for dealing or trading purposes. Samples of cash flows from investing activities. Cash payments for investing activities, we have cash payments for acquisition and subsequent capitalization costs for PPE, intangibles, and other long-term assets, cash receipts from sale of property, intangibles, and other long-term assets, cash payments to acquire equity, debt instruments, and other entities and entries in joint ventures, and then cash equivalents held for dealing or trading purposes, cash receipts from sale of equity and debt instruments of other entities and entries in joint ventures, and then we have cash advances and loans made to other parties and repayment thereof, such as that of advances and loans by financing institution. Example of cash flows from financing: cash proceeds from issuing shares and other equity instrument, cash payments to owners to acquire or redeem entities' share, cash proceeds from issuing debentures, loans, notes, and other bonds, mortgages, and other short-term borrowings, cash repayments of amounts borrowed, and cash payments for by a lease for a reduction of outstanding liability relating to finance lease. So in short, these are cash funds and cash disbursement related to some borrowings from the owner or from the financer. So, interest and dividends. So, interest in income received, operating. But we could also have it investing activities. So, interest expense paid, operating, financing activities. For dividends income received, operating, it could also be investing activity. And dividends paid to owners, financing, and then it could be a operating activity. Now, reporting cash flows from operating activities, we got direct and indirect. So, if it is direct, major class of gross cash receipts and gross cash payments. Indirect, adjust accrual base profit loss for an effect of change in operating activities and liabilities and effect of non-cash items. So, these are accrual based profit. You are going to add non-cash expenses such as depreciation, then less non-cash income, no? And then we have to less increases in operating assets, decreases in operating assets, and then you have to add also the increases in operating activities and decreasing in operating activities. We have the cash-based profit, cash flow from operating activities, no? And then events after reporting period. Events after the reporting period are those events, favorable or unfavorable, that occur between the end of the reporting period and the date that the financial statement are authorized for issue. So the financial statement had been done, but it is not yet given, or it is not yet issued. So therefore, and what are these types of events after the reporting period? We have adjusting events after reporting period are those that provide evidence of condition that existed at the end of the reporting period. And the other is non-adjusting event after the reporting period are those indicative of condition that arose after reporting period. So the difference between the two is that it exists at the end of the accounting period. The other one is it will arose after, it will come after the reporting period. Date of authorization of financial statement. The date is the date when management authorizes the financial statement for issue, regardless of whether such authorization for issue is for further approval or for final issuance to users. Example of adjusting events. So the settlement after reporting period of a court case that confirms that the entity has a present obligation at the end of the reporting period. The receipt of information after the reporting period indicating that an asset was impaired at the end of the reporting period. Example, a bankruptcy of customer that occurs after reporting period may indicate that the carrying amount of the trade receivable at the end of the period is impaired. So you cannot collect. So therefore, the asset presented is impaired. The sale of inventories after reporting period may give evidence that their net realizable value at the end of reporting period. And then the other one is the determination after reporting period of the cost of asset purchase or the proceeds from assets sold before the end of the reporting period. And the discovery of fraud or error that indicate that the financial statement are incorrect. So these are events after the reporting period. Reporting is one. Examples of non-adjusting events normally require disclosure. These are example that needs to be disclosed. So we have change in fair values, foreign exchange rate, interest rate, or market prices after the reporting period. Maybe the exchange rate for that period when you make the financial statements 20 pesos per dollar, but as of the reporting period maybe 50 pesos per dollar. So, or maybe the market price increases. Because of the improvement, it increased the amount, or because of the inflation, it decreases the amount. So, these are to be disclosed on the reporting period. Casualty losses occurring after the reporting period but before the financial statement were authorized to issue. So, you prepare December 31 and you have to issue it by January 20. But there is a casualty by January 5. So, there is now a loss that incurs during the financial statement prepared for issue 1. So, therefore, you have to disclose that the casualty have been done or a casualty have been incurred during the time before the financial statement are authorized to be issued. So it means that you need to inform that there are fire, there are storm, there are earthquake that incurred during the time before the authorized of the financial statement have been issued. Litigation arising solely from events occurring after the reporting period. Sometimes the reports are being done by December 31, but there are litigation that still on process. So therefore, this may be incurred after the reporting period. So therefore, you have to disclose this litigation, whatever be the output of the litigation. Major or ordinary shares transaction and potential ordinary shares transaction after the reporting period. So these are also be disclosed. Major business combination after the reporting period. Maybe some combinations or in a merger or that happens in order that the business will be in progress, or so therefore there are business combination that took place, so you have to disclose also. Announcing a plan to discontinue an operation after the reporting period. So maybe you have ABCD operation and you are going to discontinue the D operation because it is non-performance na. So therefore, you have to make some disclosure of this. Declarations of dividends after the reporting period. So you have to disclose also when to declare how much is to the declaration to be declared, when to declare, and when to pay, when to record and when to pay the dividends. So it's done. We are through with our module 2, and thank you. Where module 3 will be related party disclosure and operating segments. So you may do the module activities and pass within a given period. Always stay safe.